Companies and sovereigns in EMDs need to be able to make the case to investors that their issuances have tangible impact. And investors need to be able to demonstrate impact to shareholders and to standard setters wary of greenwashing and other forms of overstating impact. And the rest of us need to be able to judge whether these flows that are labeled as ESG flows are actually contributing to the goals and the impact that we all need.
I'm going to first describe why. Why did we create the Impact Disclosure Task Force? I mean, as you know, there's no shortage of task forces in sustainable finance and sustainability. So why did we think yet another one was warranted? What was the problem that we're trying to solve? Sustainable finance is a real asset class. You know, by some measures, as Nancy mentioned, there's $41 trillion of assets under management that have some measure of ESG integrated. Now, most of that is ESG integration, meaning that it's more from a risk management approach. But there's about 10% that is for sustainability and impact strategies, meaning that the investors are actually seeking sustainable outcomes and want to make a change in the world. But if you look at where that money is actually flowing, most of that is going, and Nancy mentioned this, it's going to developed markets. And there's a lot of reasons for that. There's market risk, there's credit risk, there's geopolitical risk, but there's non-financial reasons for that as well. If you are, let's say, a Brazilian agriculture company that has a business strategy to give better inputs to farmers, to increase their agricultural productivity, to train farmers, to ensure that their supply chain is free of deforestation, is free of human rights abuse, if they might be creating good quality jobs, you might completely fly under the radar of sustainable investors because you don't check one of those two boxes. That is the problem that we tried to solve with this task force. The guidance actually envisions an ecosystem that has three components. One component is that Sustainable Development Impact Disclosure, or what we're calling an SDID. And the guidance essentially gives a playbook on how entities should navigate existing resources to identify the metrics that, based on a theory of change, describes their impact intentions and helps them measure those impact intentions, then helps them do the materiality assessment to identify which ones are the ones that should be prioritized based on their local context, and then set targets for those prioritized metrics. For the negative impacts, we should also make sure that they're kind of adhering to the standards for do no significant harm, maintaining minimum safeguards by showing what are the policies and procedures they have in place that will help them manage environmental and social risk and mitigate negative impacts. So the entity will also commit to monitoring and reporting progress against those intentions, because you actually want to know what did they really achieve after they set out the vision. We envisioned a data platform where this information can be digitized, aggregated, and then disseminated at scale. And then the last component is a network of ancillary services, because at the end of the day, what's really important here is trust. And to enhance the trust, we're thinking about what are the third parties that can help with independent verification, with monitoring and evaluation, with analytics to ultimately decipher all that information and make sense of it so it could be usable for investors when they want to determine whether it's eligible for their portfolios or not.
There's no doubt in our mind that the guidelines like that will actually enhance the universe of potential investments for us. I mean, that's the baseline, there's no doubt. Just think about social impacts overall. I mean, there's an issue of being able to assess and to measure impact outside of pure carbon footprint. When the information is lacking, what do? You tend to overestimate the risk, underestimate the opportunity.
The ISSB on the task force as an observer, just making sure that we continue to build this alignment versus reinventing any wheels and participated in that context. Companies may have other stakeholders to whom they want to communicate beyond the sort of common investor as the ISSB is focused on. And so we have what we call this building block approach, where we're trying to develop the common language for companies to disclose to investors around the world, but recognize that they'll want to add on top of that in some cases. So it's in this context that we entered into the observer status of the task force to support this ongoing lack of or reduction of fragmentation and alignment as it relates to expectations for company disclosures.
We know that there are many impact and sustainable investors out there, like CDPQ, who are looking for bankable long-term investment opportunities in emerging markets. The problem is, as everyone mentioned, lack of transparency, lack of market information, which really makes it very difficult for them to assess the associated risk. Many of the disclosure frameworks today fail to address the, I would say, the impact, the development impact linked with the sustainable linked finance allocation. What this framework does is it addresses these challenges. It gives you accountability, transparency, but it also goes further to really give companies opportunity to report on progress against SDGs at a very local level. And finally, it does not only make you report on the positive impact, it also helps us look at the associated environmental and social risks and put mitigation plan for those risks.
There is this perception in a lot of circles that asking the investee to report more on impact, in particular in the rigorous way that Aras was talking about, what's the baseline, what's the change, is a burden. That's not how you're describing it. So say a little bit more about why this helps you.
The framework is pretty much aligned with many of the emerging reporting standards like ISSB and even with rating agencies. So it actually does not increase the burden of reporting because of the alignment and overlap. It just makes it easier for us to report on many of other reporting standards.
You need a framework. You need to talk about where you're going to be focusing your effort, what metrics and outcomes are you hoping to get, and how you're going to report on those, and how transparently and how often. And that's why we really wanted to participate in this, because that's all pre-issuance. That's all on an intent to attract capital, to say, when and if we raise this capital, we will allocate it to projects that are credibly green, with credible possibilities of outcome and a good governance structure and reporting to do so. And that's really what the sustainable bond industry has grown up doing. And that's from the first one several years ago to where we are now at trillions and thousands of bonds outstanding. And the questions are starting to be asked, what's the outcome? If this gives form and process to more disclosure on the benefits of some of these projects and entities in these regions, then our company will incorporate that. And what we do is basically opine and say, these are good practices for identifying what your impact is going to be and reporting on an ongoing basis. And I can't see that being anything but beneficial to a whole industry of trying to develop more projects and moving more capital to the developing South.